Hello and welcome. You're watching BQ Conversations. I'm in conversation with a very special guest this morning. Adrian Mowat, CLSA Chief Strategist, is joining me right now this morning. Adrian, wish you a very happy new year. I hope it's not too late to wish you, but it's great to have you on this conversation with me. Just want to start off first by getting your view on how do you expect 2020 as a year to be for equities, and how supportive an environment do you think we are in? Some believe that excessive money has chased equities in the US markets and as well in the emerging markets without any change in fundamentals, and that's a very risky bet. What's your take?
Yeah, so first of all, Happy New Year to you and your viewers. I think 2020 will be a very good year for emerging markets, still an up year for developed markets, including the US equity market. We've been spending a lot of time looking at the earnings forecasts in both developed and emerging markets. So the forecast for this year for developed markets is around 9% EPS growth, and for emerging markets around 15%. When we look at the developed market numbers, we see a few risks perhaps in industrials, but generally the numbers look reasonably robust. And it is important when you look at equity markets to understand what are the main stocks in those markets, what really drives them. And over time, since really the GFC, we've evolved into having equity markets with a bias towards secular growth rather than cyclical stocks. So think about some of the big names in the US, whether in the internet space, the tech space, e-commerce, etc. These are the really important things rather than your old industrial stocks that perhaps a few decades ago you would focus on. We've got the US economy slowing a bit into 2020 with just 1% GDP growth. But even with those numbers, we think we will see earnings growth in US equities. Valuations are high. We are just under 19 times forward on the S&P. That is at a 2-decade high, not quite the 24 we got to in the late 1990s, first quarter of 2000. But the context of that high valuation is a stock market with a bias towards secular growth, but much more importantly is an environment of what we define as need and fear. Investors require a return. If you have a pension fund, an insurance product, the return that's available in the fixed income market is too low to meet your liabilities. Equities look inexpensive versus fixed income. And so we have an environment where investors are long equities due to need rather than due to greed. When we move to the emerging market story, EM in the last decade, the 2010, was a significant underperformer of developed markets. And that was all about earnings growth. Developed market EPS growth compounded at an 8% in the last decade. It was only 3.6% compounded EPS growth from emerging markets. So it's hardly surprising it underperformed, and it's hardly surprising that weighting towards emerging markets is very low. Looking forward, the number for 15% EPS growth in 2020 for EM, I think is reasonably robust, with upside risk coming out of tech and also upside risk coming out of financials. I'm expecting a good inflow into emerging market equities, which will be about repositioning after a substantial period of underperformance. Right. So it's going to be, in my view, a pretty decent 2020.
Adrian, according to you, what gives at this point? We've been in a more than a decade-long bull run. Money is coming in cheap and easy, and it continues to do so. Monetary and fiscal gives have also come in, which has also led to the equity market rally. Do you feel at any point that you're going to see growth starting to bottom out, particularly for countries like India, which have seen a print of 5% of late?
Yeah, so I dispute the hypothesis around central bank easing, growth and balance sheet is the whole story for the move in equity markets. The compounded EPS growth for a decade has been over 8% for developed markets. That is the prime reason that they've gone up. The US earnings per share performance has outperformed. So this is a story of, yes, a little bit of PE re-rating, which has probably got much more to do with where interest rates are. And interest rates are low because growth is low and inflationary pressures are low. So the question is, can this continue? Well, the trend is in place. I don't see an inflection point that causes that trend to deviate as of now.
Okay. Aside from that, the tricky spot that we are in with regards to geopolitical risk, do you feel that continues to remain an overhang for equities? Or the markets have digested that and that is something that is put on the side for the time being? And the focus is going to remain on maybe the US-China trade truce?
Yes, so the phrase geopolitical risk will cover a lot of events. To me, the dominant risk to economies and earnings has been the trade dispute. There are no winners in a trade dispute, and the anxiety in the markets around US-China trade relations, economic relations, started to build dramatically in May 2018. We had 3 rounds of tariff increases, a policy that was being pursued that makes investors nervous. The Phase 1 trade deal is a very significant inflection point, in my opinion. It means that trade as a dominant policy issue for the equity market fades. I think the risk premium that's built in the last 18 months is probably underappreciated. So I'm quite optimistic about the policy of geopolitical impact on equity markets in 2020. The events that happened in Iraq with regards to the assassination of the Iranian Revolutionary Guard leader of the Quad division just reminded us again that the world is awash with oil, and that the oil price barely reacts to events that, if they'd happened 15 years ago, would have got a very big move in the oil price. It's a rather sad thing to say, but unfortunately, we've had instability in the Middle East for a protracted period of time. There are events going on there that, humanitarianly awful events, but they don't seem to be having an impact on the global economy. And I think this is why the events in Iraq/Iran have faded quite quickly from market concerns.
So should one, on the back of that, the idea is to have prudent risk management and asset allocation strategies. So in turn, when there is an event of this magnitude, then you're well balanced with regards to your portfolio. Equities, you said, are not all that expensive at this point, but nonetheless, do you feel that it's time to look at some amount of asset allocation into gold, which has also done well, and even treasuries for that matter?
No, I don't really see a compelling argument to switch out of equities, which are delivering earnings growth, into an asset which we dig out of the ground and then put back underground, as Mr. Buffett often refers to. I don't think gold has any particular features in 2020 that it proves to be a defensive, diversifying asset. You're better off sticking with where you can forecast cash flows. And I can assure you it's much easier to work out cash flows from an equity than it is from a bar of bullion.
All right, let's come to the emerging market back then. And the last time that we spoke in November, you guys were underweight on India. North Asia was the pocket to be. You said that it's not that if you're underweight, you're selling the country or you're selling Indian equities. It's just that you're making better returns elsewhere. Is that something that you're still going to see in 2020 because there are no meaningful strains of change right now? Yes,
so that is the strategy we've had in place since October. And India has significantly lagged in this rally, despite the fact Nifty is very close to all-time highs. And to me, this just emphasizes why we're so bullish on EM as an asset class, that I think you can make good money out of Indian equities as you can out of ASEAN equities. It's just I'm going to make more money at the moment out of the North Asian equities, so driven by e-commerce, technology, a bit of consumer discretionary in Korea. And these are the places where earnings growth is high and we've got positive earnings revisions. The Indian equity market continues to offer some really high quality investment stories. The economic backdrop is a bit cyclically weaker than most people had hoped for, but these high quality stocks, particularly in the financial sector, can continue to prosper despite a cyclically weak environment.
Adrian, specifically with regards to growth, we spoke about the 5% print for GDP. Inflation has started to move higher, and some murmurs and chatter on whether or not we could see a period of stagflation. Do you see that as an imminent threat?
Yes, so I mean, stagflation is quite provocative, and I think the danger in using that phrase is people will extrapolate it. The effect that we think is most likely here, that the big move in vegetable prices is a short-term, temporary, a reflection on production of the crop, availability, etc., as opposed to now a structural story that you're going to have high vegetable prices. But short-term, what that means is that Indian households will have less money to spend on other purchases as more money goes into paying for the groceries. And I think this will add to further concern about demand for discretionary products, whether they be high or low value. So let's just recognize that this is a short-term impact on the growth in discretionary income, as opposed to using words like stagflation. Because for stagflation to really be appropriately used, you would need to see pricing power across the industrial groups, and you are not seeing pricing power. You're simply seeing an impact of higher food prices, particularly vegetable prices.
All right. So, Adrian, let's come down to the fact that consumption is still an issue. We've not seen a spur in consumption activity for some time now. And this aspect, be it temporary in nature, is still going to take away from the spending power into other discretionaries as well. Do you feel that consumption will continue to lag for some more time before some active measures are taken by the government to spur demand and address the demand issue, while they've been addressing the supply side issues?
Yeah, look, I think the overriding issue has been relatively weak household income growth. So if we look at the minimum support prices for the rural sector, those have been going up much more slowly than they have in the past, as the policy is put in place of a particular margin being given to the farmers. Yes, we've got a higher agricultural prices at the moment, but I think the beneficiaries of that in the rural area will be quite limited. If we look at the urban households, because demand has been weaker than expected, business investment is weaker, less job creation. And so I think sort of household urban income growth is also weak. And so the challenge really for the government and policymakers is how do you boost that? And at the moment, I really don't see any near-term policy. I would also, just remind everyone, when you think about policy in India around the election cycle, that the current administration has a very strong mandate. They won a significant majority in the Lok Sabha. And at this stage of an administration, they're more likely to be focused on longer-term reform policy as opposed to short-term cyclical boosts, which typically in a democracy occur closer to the next election.
So, Adrian, when you're looking at when you're looking at the India growth story from outside, according to you, any measures that the government in their own scope and form can take to make sure that they help lift this growth number from 5% and get it back up to the earlier days where we probably saw 7 or 8%? Or that's a tall task?
Well, it comes back to, how do you actually achieve that? And, if that's achieved through reform that reduces the cost of operating a business, makes productivity higher, if it's ensuring that there is, a talented, well-educated labor force available, it's very easy to get foreign direct investment in, then I think that will be welcomed. If it's predominantly fiscal, then investors will have more of a medium-term concern about fiscal stability. And finally, if we look at the monetary dynamics, there would be two things I would look at there. Inflation has moved higher, so that has reduced the Reserve Bank's flexibility. India continues to run a current account deficit, so there's a sort of funding requirement that limits how much interest rates can go down by. And then we've got a practical plumbing issue, which is post the events that we've had in the non-bank finance companies, we've effectively got a bit of a credit crunch in place. And it's what the policymakers would be better off doing is really focusing on improving the plumbing, helping out some of these issues in the non-bank finance companies, making sure that the major banks have sufficient capital so that they can fill the gap, so that ultimately Indian industry starts to benefit from lower interest rates, and Indian savers aren't being penalized too much because there's a sort of flight to quality in terms of the banks they're willing to save at. So it's not an easy story for the government here. And I don't think international investors are really looking for the easy fix.
Yes.
They're happy if they see an ongoing reform. They continue to pay reasonably high valuations for the Indian equity market.
Yeah.
And there are a host of high quality stocks that still sit as core positions in my clients' portfolios.
What about the fact that they're opening up industries now and inviting FDI into certain sectors? They've opened up the coal mining industry, making some changes to the act as well. You've got reduced tax incentives for setting up of manufacturing units that we spoke about a few months ago. So are these factors enough?
Well, look, this all helps in terms of opening up industries that can create jobs and thereby create demand to capital globally rather than restricting it to Indian capital. So I think in the manufacturing sector, that's going to be fine. Coal mining, I don't think so. There is a story that's very significant in terms of people's concern about the environment. Most of my continental European investors have moved to an ESG benchmark. But there's also a very important economic story here that producing electricity with thermal coal is more expensive than producing electricity using renewables. And if we look at the dynamics of this, 70% of the world's coal is burnt in Asia, and India and China dominate that. Building new thermal coal plants is probably a bad investment decision. And what I think you will find is that, yes, you might open up sectors like coal, but you're not going to find international capital moving into that. We're currently in an environment where we're watching these wildfires in Australia, a major coal exporting country. And it's really a good wake-up call to the environmental damage that's going on. But I think when you combine the ESG story with an economic story, which is a very clear one, that this is an area that global investors are not going to be interested in.
Well, my last few questions, Adrian. Firstly, if you were to make an investment in India, I'm sure there are a few sectors that you've shortlisted as being growth drivers, and therefore investment out there is warranted. What are those sectors that you're looking at?
So the biggest sector in the market, which is financials, which is dominated by high-quality private banks, I think will continue to outperform. We do like cement, and cement sort of fits in with, we do expect to see some recovery in housing construction after a long period of time trying to deal with excess inventory. But the sector positioning is quite narrow. So high quality private banks, insurance, we think are the outperformers. So in my regional portfolio, I'm neutral those and underweight the balance of the market.
All right. Adrian, it was great talking to you. Thank you so much for sparing time and speaking with us this morning. Appreciate it.
Pleasure. Thank you.
Thank you. That was Adrian Mowat, CLSA's chief strategist, talking about 2020 and his outlook thereof. India still continues to remain underweight.